The cumulative returns for the previous decade show that this belonged to U.S. equities, followed by India and developed markets. On the other hand, emerging market equities and gold were the worst performers. A majority of this performance till end of calendar year 2021 can be attributed to an era of low interest rates across the globe. Due to this tepid growth and subdued inflation, risk-seeking investors took shelter in those global equity markets and sectors, which exhibited higher stability and linear earnings growth trends. Consequently, foreign institutional investors flocked to developed markets, specifically U.S. tech, while flows to emerging markets remained muted. In India, from an investment style perspective, the last decade belonged to the earnings momentum and quality style, and the value style underperformed. India has progressed from the erstwhile vicious to the current virtuous business cycle. India is expected to move from a $3 trillion economy to a $5 to $6 trillion economy over this decade. Capex trio, which is government, corporate and household, are now in motion. Credit growth is steadily improving. Unsold inventory in real estate sector has reduced materially in the recent quarters. Nifty 50 EPS is expected to more than double from FY20 levels by FY24. As per the temperature gauge index, valuations are still in fair value zone. For incremental investments, we continue to suggest 50% deployment immediately, and 50% to be staggered over 3 to 6 months, while being able to accelerate deployment during sharp corrections. Based on trailing 12 months, Nifty 50 EPS, temperature gauge index, suggests that large cap valuations are still in fair zone. We maintain a bias towards multi-cap and select mid and small cap strategies across MF, or PMS, or AIF platforms. The RBI is currently in phase 3 in the path of normalization. The RBI aims to achieve twin objectives of tackling inflation while supporting growth. Spread between 3 years and 5 years is 19 basis points, while the spread between 5 years and 10 years is merely 10 basis points. Hence, for fixed income portfolios, we suggest core allocation to a 4 to 5 year maturity segment through high credit quality, target maturity debt funds, which invest in a combination of GSEC, state development loans, and AAA rated instruments. Tactical allocation to select high-yield strategies, MLDs, REITs, and InvITs, can help enhance the yield on fixed income portfolios. Delphi, ASAP, is an all-weather strategy that benefits from asset class diversification and yearly rebalancing. It is positioned as a superior alternative to fixed income,